Hello, everyone, and welcome to today's session, Exploring ICE, Arabica, and Robusta Futures Contracts. I'm Mary Pettit, Ambassador North America at the Global Coffee Platform, and I'll be your moderator today. I'm pleased to welcome you to our webinar on behalf of GCP members everywhere. Today, we're with you from New York City, sitting down with GCP member ICE Futures to explore how ICE, Arabica, and Robusta coffee futures contracts operate as fundamental risk management tools in the modern world where we're confronted daily with changing technology and shifting global risk management factors. As you may know, in 2019, GCP issued a call to action asking the global coffee sector to collaborate in overcoming the current crisis of low coffee market levels. Over the past few years, this dire situation has threatened the lives of smallholder coffee farmers, the environment, and therefore the coffee industry itself. Rising to meet this challenge and ensure a thriving, sustainable coffee world for the next generation demands committed global collaboration from all of us. That's why GCP's call to action is founded in 4 fundamental action areas that include, number 1, engaging with the international coffee exchanges to expand knowledge about how price discovery and risk management work in the modern electronic trading environment. 2, encouraging roasters and retailers to increase purchases of sustainably sourced coffees and promote consumption in coffee importing markets and coffee producing countries. 3, activating stakeholders in producing countries, including governments, producers, businesses, and donors, to strengthen the enabling environment for sustainable coffee production in collaboration with public-private country platforms. And 4, mobilizing governmental agencies, the private sector, and civil society to achieve policy changes enabling a living income and the economic viability of coffee farming. In our session today, we'll talk about how international futures markets work in the modern electronic trading environment. But first, a couple of housekeeping points. We'll be moving directly through the presentation, leaving time for questions at the end. We'd love to hear from you, so please use the question box to send your questions, and we'll collect them and address as many as possible during our time today. Also, today's attendees will receive a link to access the recorded version of this program, and it will include the presentation deck in PDF format to download on demand. For those of you just joining us, welcome. We're with you today from New York City at ICE Futures US for a webinar exploring ICE Arabica and Robusta futures. ICE operates the world's leading network of regulated exchanges and clearinghouses, including the New York Stock Exchange. Now I'd like to introduce our speaker, David Farrell. David is Chief Operating Officer at ICE Futures. He's responsible for product management and operations globally for the soft futures markets, including ICE Futures, Coffee C, and ICE Futures Europe Robusta coffee contracts. Dave, thanks very much for sitting down with us today. And now over to you.
Thank you, Mary, for that kind introduction. And I'm very happy to be presenting to such a large and diverse audience, particularly at this busy time of year, up at the end of the year, coming up against the holidays. So thank you all for taking the time to attend, and thank you to the Global Coffee Platform for hosting this webinar today. I'm going to speak mainly about the 3 primary functions of our coffee futures markets. However, I wanted to start with a bit of background on my firm, Intercontinental Exchange, or ICE. So ICE is a relatively young company. We were founded in 2000. At the time, we were operating primarily as an electronic marketplace for over-the-counter U.S. energy derivatives. And over the years, we've grown both organically and through acquisition. And really, we first entered the agricultural space, or the coffee world, through 2 acquisitions. The first being in 2007, when we acquired the New York Board of Trade, which is where the Coffee C contracts traded. And then later in 2013, when we acquired Nicey Life, which was the home of the Robusta futures contract, which traded on their London exchange. So ICE, we've been operating in the coffee markets for about 12 years now. So in a way, we're new to coffee. But if we were to consider the history of the firms that we acquired, our roots in the coffee market really go much, much deeper. So if we're to trace back the origins of the agricultural markets that trade on the ICE exchanges, on the New York side, we can trace back all the way to 1870 with the formation of the New York Cotton Exchange. Almost that far back in 1882 was the first foray into coffee, with the foundation of the Coffee Exchange of the city of New York. And these two exchanges, along with the New York Cocoa Exchange, really formed the foundation of what would later become the New York Board of Trade in 1998. These markets now operate on our US exchange at ICE. It's called ICE Futures US. In London, the markets go back almost as far as they do in New York. In 1888, we saw the formation of the Coffee Trade Association. And really, if we look across our 4 agricultural products on our London market, all of them have roots that date back prior to World War II. During World War II, there was actually quite a lot of damage to the buildings that housed these trade associations, so much so that the operations of the association ceased for a period of time during the war and shortly thereafter. And it wasn't until the 1950s where some of these associations and markets started to be reformed, a lot of them under the guise of the London Commodity Exchange. So they reformed those markets in their modern form. That included coffee futures in 1958. So the London Commodity Exchange, or LCCE, would go through a couple different iterations, but it will eventually become a part of NYSE Life, which is now, by our current nomenclature, is known as ICE Futures Europe. So this list is just a demonstration of the various origins of the agricultural products that trade on our various ICE markets. And I think the point here is really that ICE is probably a relatively new name to the coffee market, but it's really just the most current form of a slow evolution in global trade practices and risk management practices in the agricultural commodity markets. So that's a bit of background on ICE, but what is ICE? So ICE operates a number of exchanges and clearinghouses around the world. These are 2 pieces of market infrastructure which work together to operate the market as an ecosystem. So in the broadest terms, the exchanges are responsible for governing the futures contracts, so setting the terms and conditions that they'll trade by, for overseeing the trading activity and making sure it's orderly, and then for matching the counterparties. The clearinghouses, on the other hand, work in the background to manage positions, to assess risk. In a way, they also govern access to the futures exchange, in that if you want to trade on the futures exchange, you need to have an account with an associated clearinghouse or a clearing firm at that clearinghouse. So today we're going to focus mainly on the exchange part. And when I think about the purpose of an exchange or a futures market, it really serves 3 primary functions. The first being risk management. So we offer contracts that allow firms to offset their commercial risks that exist in their business. The second is price discovery. So we provide a market that helps to uncover the prices of standard commodity specs. And the third is the exchange is a buyer and a seller of last resort. So if you're a seller and you have surplus stock that you can't sell to your network of buyers, you can come to the futures market and pass on to other participants through the futures exchange. Likewise, if you're a buyer, you have a commercial need for a good, and you don't have access to supply in your networks of suppliers, you can purchase goods from the futures market. So if we dig in a little bit to the first primary function of the exchange, which is risk management, the primary tools that we offer to manage risk are futures contracts and options contracts. A futures contract is a contract to buy or sell a specific quantity of goods, in this case coffee, at a specific price and at a fixed period in the future. So these are done on standardized terms. So for example, the quantity. Our Robusta contract trades in 10 metric ton quantities. Likewise, on the Arabica side, they trade in approximately 17 metric ton quantities. The actual specification calls for 37,500 pounds. It also has a par quality, a standardized quality. So for example, on the Arabica contract, we have a set of named origins with specific levels of defects and cup characteristics. And it trades over a discrete period. So some period in the future, potentially, for example, March. So for delivery in March of 2020. We also offer options contracts. These are a bit of a more sophisticated instrument. It provides the buyer the right, but not the obligation to either buy or sell the futures contracts on the same standardized terms that we mentioned above. And in addition to the futures and the options, we also allow what we call combination markets. So if we take, for example, a spread, so you have a need to buy coffee in March and sell it in May or July, we allow you to do that in a single transaction, which we call a spread market, which would be the March-May spread. So if we focus on the futures example for a moment, if we were to visualize the purpose of futures on a price chart, it's really about protection. So buyers are typically looking for protection from higher prices in the future. They know that they have an obligation or a need to buy later in the future. They want to ensure that they're not going to be harmed if the prices do rise. So effectively, what they're aiming to do is to help themselves to buy low. Likewise, sellers want to protect themselves from lower prices. So they know they're going to need to sell goods in the future. They want to ensure that if the prices do fall, that they're not harmed by those falling prices. So they effectively are trying to use the futures market to strategize to sell high. So what are some practical examples of how these contracts are used throughout the supply chain in coffee? So if we take three examples of participants in the supply chain, a coffee producer, a merchant, and a roaster, we can talk about how are they using these instruments in their everyday business planning. So a producer, for example, a farming cooperative, their general business in very simple terms is they grow a crop throughout the season and then they sell it at the end of the season. As the co-op starts to plan for the crop year, they may look at their operation and they may estimate their operational expenses as well as forecast their crop. They can then go out to a bank and say, I need some help covering my operational expenses before my revenue comes in from the crop at the end of the year. So they can go to the bank, they can ask for a loan. The bank may be willing to lend to that cooperative based on future expected sales, but they also want some protection that in the case of the price declines, that they're going to be able to pay back their loan. What the futures market allows the co-op to do is to go to the market to sell futures at the current price for the harvest period to ensure profitability if the price were to drop further than it is today. So if the price does drop, they will receive less revenue from their commercial sales of the goods that they've harvested, but they'll also have some profit baked into their futures trade, which allows them to remain profitable and make good on their loan back to the bank. The merchant, on the other hand, their business is really about buying from producers such as a cooperative, transporting those goods into a position where there's demand, and selling the coffee to consumers, for example, to a roaster. So the merchant is really making purchases early on in the crop cycle, say in March, and they're looking to merchandise those goods and sell them later on in the year, say in May or July, to their roaster customers. So they want to ensure that they're selling coffee for a higher price than where they're purchasing it. So they may go to the market and sell a futures spread. So what this allows them to do is lock in that end-to-end profitability from purchasing from the producer, carrying the goods for some period of time from March to say July or August, and then selling to the roasters. And the last example we have is a coffee roaster. So their business plan or business model is pretty obvious. They're buying green coffee as an input to a roasting process, and they're selling a finished product of roasted coffee. So they need to ensure that their green coffee input costs don't breach some break-even profitability level. So if they know what that profitability level is, say they need to keep their input costs below X, they can go to the market and they can buy a call option with a strike price of that X, whatever their break-even cost is. And that protects them against price increases. So in this case, when they have their option trade, if the price were to increase beyond that break-even level of X, they have the right to buy the futures at the lower price and help maintain profitability for their business in a high price environment. So our futures markets are really designed to bring together the different parts of the supply chain into a single place to transfer risk. So you could be a producer, you could be a co-op, like we had in the last example from a producing country. You could be a processing facility, say if you're in Vietnam preparing clean grade 2s for export, or you could be a roaster in Europe or the US. So these firms may not ever interact commercially or bilaterally, but if one has a risk on the long side and one has a risk on the short side, they can come to the futures market, they can transfer those risks to each other to mitigate those risks and resolve a business or commercial risk in a single place. This really brings us to the second primary function of the market, which is price discovery. Price discovery is really about bringing transparency to transactions. So everybody wants to know, at what price is a certain commodity trading, is coffee trading globally. This is really dependent on two things. One is consolidating as many participants as possible into a single place, into a single market. And the second is that everybody's pricing the same thing. So having a known standard quality specification that serves as a reference price. So when this occurs, you can create transparency around the benchmark price for coffee. So in this case, the futures or the price in the futures market is not the exact price of all beans in the world, but it is a price that can be used as a relative gauge for the value of any bean that is out there. One of the characteristics that helps facilitate this price discovery and bring people to the futures markets is that they're now fully electronic. So the example that we have here on the screen is of WebIce. This is our proprietary trading platform. It's displaying the consolidated activity across the market into a single order book. So if we look at March, for example, what I'm displaying here is the 5 best bids and 5 best offers for the purchase or sale of coffee for delivery in March. At this point, the market was trading at about 109, so it's from just over a week ago. But I think the point is any participant in the supply chain can access this information. So it could be a trader who needs to execute a hedge. They can come to the market, they can look at what's available, and they can decide if they want to buy or sell in this market. Or it could be a farmer who's just looking for a reference price. They need to gauge for, what is the global market for coffee bearing for the goods that I might produce. But the point is, anywhere in the world, there's access to this information in this market. So what's an example of how price discovery originates in the futures market and then flows through to the rest of the commercial market? So For the futures, it always starts with deliverable supply. In the futures market, deliverable supply is coffee that meets the contract specifications and is also in the position to be delivered. So the coffee would be exported from origin. It would be shipped to a destination market in the US or Europe and stored in an exchange licensed warehouse. From there, one of our samplers would draw a sample, and they would send that sample to our grading room to be graded by one of our licensed graders. As these graders go through and assess the quality of the coffee, the exchange is consolidating all of those results into a report and publishing that report for the broader market to evaluate. So both of our exchanges publish grading results daily if there is grading that's taken place. They also publish daily inventory reports so that the market can evaluate what is the available supply to the futures market. So this inventory information helps the buyers and the sellers of the market understand not only the available supply, but they can combine that with the information they have on the demand market to inform the bids and offers that they're going to place in the marketplace, particularly when approaching an expiry. The resulting transactions from those orders and the accumulation of those transactions help to establish the market as a benchmark price. And what can we do when we have a known benchmark price? Really, you can price anything coffee related. You know what coffee is trading at exchange locations on the exchange spec. You can price beans that are that same quality in a different location by understanding how those locations differ. Or you can price beans that are of a premium quality by taking the futures cost and adding a differential, for example, 10 cents. So this table is an illustration of how commercial value is derived from the futures contract. The futures price is really a base or a common denominator for commercial value of coffee anywhere in the world. The specific differentials can be added or subtracted to the futures price in what we call the basis. So if we were to look at the Robusta example, the futures contract is the standard is an FOT contract that's received in a licensed warehouse, typically a European port such as Antwerp. Commercially, the basis could be made up of a number of things. It could be a price differential for a specific premium origin. It could be a differential on the shipment terms. So you could have a lot of coffee that you want to sell, but you want to deliver directly into the roaster's facility rather than have it received at a warehouse. There could be a differential price for that. Or it could be a differential on the observed quality standards. So the quality that you're looking for in coffee is a different standard to what's available on the exchange. Arabica has a slightly different set of standard terms. Notably, it's an in-store contract rather than on an FOT basis. And it also has built-in origin and locational premiums and discounts to the contract itself. But the same basis concept can apply when using futures as a benchmark. So ultimately, the futures market can be leveraged by the industry to value any commercial coffee lot available by knowing what the futures price is and knowing how that specific lot of coffee differs from the standard futures specifications. So that brings us to our third primary function, which is as the buyer and seller of last resort. This function allows the exchange to help clear the market if there is either a surplus or a deficit. So a necessary starting element of this function is our grading process. So for Arabica, we grade here in our Midtown New York offices, which we're in today, downstairs from where we are. For Robusta, we have a separate grading room that's in our London offices. In the grading rooms, we really want to answer two questions about the coffee samples that we receive. The first is, does it meet the minimum spec for delivery? So is it going to pass grading to be eligible to be delivered against the contract? And the second is, does it justify any premium or discount based on the quality of the coffee? Once we have those questions answered, we can either pass the coffee and certify it, but allow it to become eligible for delivery on the exchange. So as we think about grading, if we use Arabica as an example, you may receive a premium or a discount for exceeding or falling short of quality parameters. So the quality parameters that we're looking at are some defects are based on the bean itself, for example, mold. Others are based on foreign matter that we'll find in the sample, for example, sticks or stones or non-coffee items. And the third would be a cup test to ensure that, in our language, it is free of unwashed flavors in the cup. So I have a short video which it gives an example of the coffee grading that occurs here in New York. It also has some clips from the cocoa grading that also occurs downstairs. So just getting back to our example of when the exchange is used to clear the market as a buyer or a seller of last resort, three very simple situations come to mind. One is the situation of a surplus. So if you're an owner of inventory who you can't find a customer to offload some of your inventory to, but you no longer want to pay for the storage and to carry this coffee, you can come to the futures market, you can sell futures, and you can deliver it to the exchange to another buyer. In the opposite situation, in a very tight supply market, say a roaster needs exchange quality beans, but they can't source it from their network of suppliers. They could buy futures and receive exchange quality beans from the futures contract to fulfill that need. And last, which we would call a carry trade, an owner that has inventory that they don't need now, but they may need 6 months from now, but it's going to cost them money to store and carry that coffee and insure that coffee for that period of time. They can come to the market and they can sell futures in the near term, and they can buy futures at a point later in the future. That allows the market, which may be able to carry it more efficiently, to carry that coffee for them, and then when they receive it back, they still have the exchange quality coffee that they need to fulfill their needs 6 months from now. So for futures contracts, liquid, well-functioning contracts really exhibit these primary functions, and they build on each other. So if we work backwards from our examples, when the exchange is an effective buyer and seller of last resort, that really helps to reinforce the price discovery in the futures market, because people know that this is a price that physical coffee is actually going to clear at as we approach the expiry. That price discovery then reinforces the risk management. It attracts more participants to the market from across the supply chain, because they know that if they execute a futures or an options contract, it's going to be an effective hedge for their commercial needs. As these principles support each other, it leads to liquidity. Now, liquidity can mean many things to many people, but from the exchange perspective, a liquid market is about allowing participants to trade into or out of positions without a price impact or without moving the market, as they say. So we're constantly trying to grow participation to minimize that friction of getting into and out of the market. So I wanted to talk a little bit about the growth in participation and close on some basic statistics about the growth in our market over the last several years. So this chart is for our coffee C contract. It is derived from the CFTC's Commitment of Traders report, and it shows growth in participation by customer type publication since the publication began in 1986. So you'll notice that whether it's commercial or non-commercial, on the long side, on the short side, all of these participants are really increasing at a similar rate. So in our view, it's because the market is symbiotic. So the more commercial participants that are there to hedge, the more non-commercials are going to turn up to provide liquidity, and vice versa. The more liquidity that's in the marketplace, the more commercials are going to be able to access that liquidity to hedge their commercial exposures. If we were to look at it in a slightly different way, this chart shows the total positions held on the market by commercials, non-commercials, and non-reportables or small positions. So over that same period of time from 1986, where participation is growing quite quickly, the share of the total positions held by the commercials, which is the dark blue line at the top, stays in a relatively constant range. It's typically between 40 to 70% of all positions in the market. So this is an indicator to us that there's a strong commercial foundation rooted in the futures market. And what it leads to is a healthy, balanced market where the commercials and the speculators are supporting each other. So just to conclude and summarize the main points from today. So futures contracts really allow somebody to buy or sell a standard spec quality of coffee in this instance for fixed periods in the future. So we have two main markets. We have the Arabica futures market, which is the coffee C market, which trades on ICE Futures US. We also have the Robusta futures market, which trades on a different contract on our ICE Futures Europe exchange. Both of these markets are centralized places that consolidate activities of participants from all parts of the supply chain to transfer their price risk. We try to tailor the contracts to be relevant to the widest cross-section of participants to ensure the maximum amount of liquidity available to the market. And lastly, we're a service provider to the industry. So we distribute not only our daily price reports, but we also distribute inventory reports and grading results, which are available free on our website. So before we take any questions, I wanted to say thank you again to Mary and the Global Coffee Platform for hosting us. We really look forward to these types of opportunities to engage with the broader market, and really appreciate the time that she spent putting together this webinar and organizing this webinar for us.
Thank you, Dave. We have questions coming in, so please let us know what you're interested to know more about, and Dave's glad to address them.
So the first question we have coming in is, does the valuation of premiums become more difficult to determine due to increased specific and individual characteristics of specialty coffee? So I think the answer is yes and no. I think it's not more difficult to determine the premium if you understand the difference between the spec that you're trading as a specialty coffee and the exchange spec. But what it does do is it fragments some of the commercial activity that's happening. So you may have an understanding of the differences, but valuing those differences may become more difficult as the specifications and characteristics become more individualized.
We have a question that's just come in, and the question is, how is ICE addressing the fact that Brazilian naturals represent a disproportionate share of coffee hedged on the exchange, even though these grades are not deliverable?
Well, I think from our perspective, when we look at what the price of coffee, what the price of the coffee is representing on the futures market, it's representing what is deliverable, which would be Brazil to a certain extent, but a number of other origins as well. I think the fact that people are hedging more and more coffee in the marketplace that is not necessarily deliverable. When you get down to expiry, the delivery mechanism itself is going to come into play and is going to really help anchor the price on the deliverable specification of the futures contract. So the next question we have is, what are the financial requirements to open an account to trade coffee futures? So as we talked about a little bit in the beginning, the access to the futures market is really governed through the clearinghouse. So our clearinghouse has a number of clearing members who are required in order for any participant to access the futures market. The clearing members will do their due diligence on the accounts that they're willing to assess. So they want to make sure that their customers have the financial wherewithal to bear the risk that they are guaranteeing on their behalf to the clearinghouse. So if we're looking for specific financial requirements, if you were to go to our website at theice.com, you can see a list of our clearing members, and you can reach out directly to the clearing members to understand for each individual clearing firm what their requirements would be, because it will differ slightly from clearing member to clearing member.
Thank you. We have another question that's just come in, and it is, how are the coffee futures markets regulated and by whom?
So the regulation of the coffee futures markets is going to depend on the jurisdiction. So we have our Arabica contract is here in the U.S. So both our U.S. futures exchange and our clearinghouse are regulated by the CFTC, which is a U.S. government organization that oversees to make sure that we as regulated entities are meeting our obligations to the market to run fair and orderly markets. Our Robusta contract, which trades on ICE Futures Europe, has a different set of regulators. So their futures exchange is regulated by the FCA, which is the equivalent of the CFTC in the UK. And the clearinghouse is regulated by the Bank of England. So they actually have two regulators that are overseeing their ecosystem of an exchange and a clearinghouse.
Thanks, Dave. Here we have a question regarding how ICE publishes data. The question is, why does ICE publish Arabica and Robusta certified data differently? For example, the Arabica data includes origins, while the Robusta data does not.
So the reports that the two exchanges developed separately under separate entities. So the reports that we publish are a legacy of those separate entities, and we have tried to come together to harmonize as much as possible so that you're looking at similar data across the two exchanges. But we're also trying to balance that with people having historical data sets that are speaking apples to apples. So when they look back historically, they have an understanding that they're looking at the same data set today that they had 4 or 5 years ago. So it's meant to be a balance of the two, and we try to toe that line as best we can to provide the best information and most standardized information while also maintaining the historical integrity of those data sets.
Thank you, Dave. Another attendee is interested to know, what do you consider as an adequate liquidity, and how has this been fluctuating in history?
It's a very tricky question to answer. I think liquidity means something different to everybody. For us, it's about making sure that your average customer and your commercial customer can come to the market with a standard size bid or offer and be able to execute that without moving the market. I think the tricky part is that for every person, the standard size that they may be trying to execute would differ. One thing I will say is if we look at the growth in participation, if we would overlay that with growth in open interest or growth in volume, they tend to mirror each other, where over the number of years since we've electronified the markets, the volume has been increasing, which should mean that people can execute larger transactions with less price impact, as well as the open interest has been increasing, which means that people can hold larger positions and be able to get into and out of those positions more easily based on the volume.
Thank you, Dave. Here's another question. An attendee is interested to know, could you please explain what is the process involved to become a licensed coffee C grader?
And we have an expert with us, Mary, who is one of our graders. So we issue a seminar every year. Is that right, Mary? And then an exam we issue at least once every 5 years.
3 to 5 years.
Every 3 to 5 years. So effectively, what we're doing is we have our board of coffee graders who puts together and actually does a lot of work to put together an exam that will test the skills of each individual applicant to identify defects in the beans, and then more importantly, well, not more importantly, but just as importantly, to be able to identify defects in the cup. And when we offer that, we open it up to applicants, and we encourage people to keep their eyes out for that, because we are always looking for new applicants and new graders to join our ranks.
Thank you, Dave. Can you also please let us know, where can we all find the ICE Commitment of Trader reports?
So the Commitment of Traders report is not published by ICE itself. The information is, we help collect the information on behalf of the CFTC, and it's published on the CFTC website, which I'm sure as a follow-up to this, we could provide a link to those reports. And they are available historically, going back to the initial publication date, which I believe was 1986.
So ICE does, however, publish the certified stock reports for both Robustas and Arabicas, right?
We do publish the certified stock reports for Robusta, for Arabica, and I believe on the Arabica side we also have commercial stocks that are in our exchange warehouses. And also, just to note, on the London side, we do publish the Commitment of Traders reports ourselves. The CFTC does not do that for the London market. We do it as a courtesy for the London market, since they're not regulated by the CFTC.
Here's a question coming in. David, could you please tell us a little bit about the global structure of the ICE organization?
So ICE is, we're a publicly traded company, which is listed on the New York Stock Exchange. We are a collection of a number of different businesses. Many of them are exchanges and clearinghouses, but we also have other businesses that are either data businesses. We have a benchmark administrator, which they run auctions for instance, the London gold price and the LIBOR price are run through our benchmark administrator. And we have another number of different ancillary technology firms. Generally, the senior management at ICE is made up of the presidents or the heads of these businesses, which are operated around the world in different jurisdictions.
Here's a question that has just come in. Is there a chance that ICE might consider some form of premium structure for sustainably sourced coffees? And if so, what would be the route to discuss that possibility?
So we've actually had a number of those conversations, and I think in the past, and we anticipate continuing to have those conversations in the future. Really, what our goal with the futures contract is to reflect what's going on in the commercial market, and if there are ways to broaden the deliverable supply and broaden the exposure that people have, or the access that people have to the market, we'd like to be able to do that. A lot of it depends on the transparency and the verification methods that are happening in these sustainable initiatives. So when we design the futures contracts, we want to be able to ensure that the quality specifications that we're associating premiums with are ones that we can verify ourselves. So that's one of the challenges that we have, but it's one of the areas where we engage quite frequently with many of the different participants in our market.
And Dave, can you please tell us a little bit about the ICE Coffee Committee and how it's structured and how it works?
So we, as an exchange, a lot of the expertise on physical coffee and how it's traded in the physical market, it doesn't live in the exchange itself. It's in the industry. It's with the trade houses and the roasters and the growers. So we try to find as many ways as we can to receive advice and tap their expertise so they can help guide us to make sure that the futures contract are reflecting the commercial realities. Our committees are one way that we do that. We try to get a sample of a cross-section of different interested parties to come together and debate issues that we're having in the contract. So it may be we have questions about warehousing, or we have questions about deliverable grades, or we have questions about storage procedures. So we'll use those as a sounding board and guidance in order for us to help design any changes to the contracts that we need to make sure that we're evolving along with the commercial market and reflecting the realities of that commercial market.
Another question just in is, has ICE considered opening up new origins for delivery to the exchange, such as Asian Arabicas from Vietnam and China?
We frequently consider and periodically consider different origins, different delivery locations. It is part of the advisory process and consultation process that we do, not just with our committees, but with other customers. And we're constantly trying to evaluate, what is the commercial relevance of a lot of these different origins to the global market, and how are they reflected in the global market. So it is something that we consider often. It's not something that we change often, but it's something that we consider often as we try and keep in lockstep with the commercial market.
Here's an observation and a question. An attendee writes, "It bothers me that the video featured exclusively what appeared to be white men. I believe trading is seen as a male-dominated industry, but how might we all work together for a more inclusive, welcoming culture as we expect this of companies and their cultures in 2019?
I think, well, I'd have to go back to the video. We do have more than just white men that are graders, and both on our board of graders as well as in the grading roster itself. I think as an industry, it historically has been male dominated, and everybody needs to play a part in being inclusive. I think that's especially true for us as we're periodically and constantly trying to increase the skilled graders that we bring into the exchange.
Yeah, this is Mary speaking. As a licensed grader, I believe that currently in the active grading roster, there are 3 women, and we've had up to 5. But the grading exam is open to everyone, and we encourage everyone to apply and to take that test. I've had my grading license since 1989, so I'm probably, the oldie grader here, but I'm really encouraged to see so many more women getting involved in the physical side of the coffee industry, and I believe that the number of women graders in ICE can only go up. An attendee is asking us regarding differentials against ICE New York C. Are these available, or is this private information?
We do not publish any differentials aside from the stock origin differentials that are part of the contract terms itself. But I do believe there are organizations out there that publish some historical information on differentials for a certain subset of origins.
Another attendee is asking, where can I find the rules and regulations to tender coffee to the C contract and to the London contract?
So the complete rules in our rule books on both sides, on the London side and on the New York side, are 100% public. So if you were to go to our website and look up on each of the exchanges, they'll have a regulation section, which has the rule books for all of our contracts, in which you would be able to find the Coffee C rules. On the London side, you would find the Robusta contract rules, their administrative procedures, and they also have a separate section on warehouse keeping, so a separate rule chapter for warehouse keeping alone.
An attendee has asked, any chance you can shed some light on what happened with the De Los Andes cooperative in Colombia?
Unfortunately, no. I don't think I'm the right person to help with that.
Have just another couple minutes for questions, and we're glad to take more. We want you to know that we're going to be sharing this program, sending you an email link that will also include a PDF download of the slide deck. Since we're just about out of time, we want to thank everyone for attending. And Dave, thanks to you and ICE Futures for taking this time with us today.
We appreciate you hosting us, and please do use the contact information there to reach out to any of us with any further questions.
Remember that the recording and PDF of this presentation will also be made available on the GCP website at globalcoffeeplatform.org. And on behalf of all of us at GCP and from ICE, thanks to everyone for sharing this past hour, and we wish you a good rest of the day.